Let's talk about America's debt crisis. The United States government is on track to spend about $6.5 trillion in 2024, which is about $2 trillion more than what the government is going to bring in from taxes. But the United States government can't just create these trillions of dollars out of thin air per se, so every time the government spends a dollar that it doesn't generate from taxes, the government has to go deeper and deeper and deeper into debt. But it's really hard to conceptualize how much $35 trillion of national debt really is, so to help understand, let's assume that $1 is equal to 1 second. That means $1 million or 1,000,000 seconds will be equal to around 11 days. $1 billion or 1,000,000,000 seconds would be equal to around 31 years. $1 trillion or seconds would be equivalent to 31,688 years, and $35 trillion, the amount of national debt that we have, if we turn that into seconds, would be equivalent to 1,109,000 years. And this is how much debt the United States government has. Now, the question I want to answer today is this a problem? And if so, how big of a problem is it really? Being in debt is not a new concept for the United States. The United States first went into debt back during the Revolutionary War in 1791, but over the last 100 years especially, we have seen the national debt explode in the United States. So there's two concepts I want you to understand: national deficit and national debt. The national deficit is when the government spends more money over the course of 12 months than what they generate from taxes. So in 2024, the government is going to spend around $6.5 trillion, and it'll generate around $4.5 trillion, which means we have a $2 trillion national deficit, which then adds on to the total national debt, which is a total amount of debt that we've carried year after year after year that we have not paid back yet. But the problem that I want to highlight is not how much debt that we have, it's how much debt we have relative to our collateral. Think of it this way: you own this home and you owe $1 million to the bank on your mortgage for this home. Is that a problem? Well, it depends. If this home is worth, say, $2 million and you owe $1 million, which is of course a lot of money, and you can make the monthly payments, then no, it's probably not a problem. But if this home is worth $500,000, now it might be a problem, especially if you can't make the monthly payments. And this is what we want to pay attention to. What is the collateral versus the debt? The collateral here in the United States is our economy, which is measured by a number called GDP, which takes a look at all the sales that have happened in our economy. So to illustrate this, what I want to do is take a look at how much national debt the government has had over the last 4 decades, but not just look at the amount of debt, but compare this amount of debt relative to the size of our economy, which is the GDP. You might have seen us talk about this in Market Briefs. Market Briefs is my free financial newsletter where every day my team is working to break down what's happening in the economy, the housing market, the stock market, the crypto market, and the global economy into a fun, witty, and easy to read newsletter. It is completely free, and if you have not joined Market Briefs yet, well, what are you waiting for? If you want to join Market Briefs, I got the link to how you can join down in the description below. In 1984, the United States national debt was $1.5 trillion, which was 39% of our total GDP. By 1994, the national debt jumped up to $4.7 trillion, which was 66% of our total GDP. By 2004, the national debt jumped up to $7.3 trillion, but the debt to GDP levels actually fell from 66% down to 60%. It was looking good. But take a look what happens next. Between 2004 and 2014, the national debt really jumped up. We went from $7.3 trillion up to $17.8 trillion, which is now 101% of our GDP. We have more national debt than the size of our economy. And then take a look at what happened just now. We're now sitting on over $35 trillion with the national debt, which is 121% of GDP. Is this a problem? Well, let's go back to the example that I gave you earlier of the house. If you owe more money than what the house is worth, is that a problem? Well, no. You can be underwater in your house and it not be a problem as long as you can make the monthly payments. If you can make the monthly payments, the bank doesn't care. So let's take a look at what's going on with our payments. The United States government is not a for-profit entity like Amazon. They're not creating a product trying to sell it for a profit. Instead, the government collects tax dollars from taxpayers. So you go to work and you get paid and you got to pay taxes. You start a business and you make money, you got to pay taxes. You make an investment and you make a profit, you have to pay taxes, and then the government collects these tax dollars, and then they use these tax dollars to pay all their expenses. They pay for the infrastructure, they pay for the military, they pay for teachers, they pay for bridges, and they also have to pay back this debt plus interest. Now, we've pretty much established that the United States government's expenses have been rising decade after decade and year after year, but along with that, the revenue for the United States government has also been rising because the government has been collecting more dollars from taxes, but the problem is that expenses for the government have been rising faster than income from tax dollars. And the most interesting part about this is the fastest growing expense for the United States government is not the military, it's not Social Security, it's not healthcare, it's net interest expenses for the government, because the debt load has become so big that now the interest payments on the debt are now larger than how much money we pay to our own military. So the United States government has this $35 trillion worth of debt that they have to make payments on plus interest. And how do they actually pay this money back? With taxes. And the amount of money that the government is collecting in taxes is rising, but it's not rising fast enough to keep up with the higher costs, which means the government has two options. We have more taxes, or we have what I like to call the hidden tax, which is something that you need to understand. If the government raises a tax to fund an expense, it's very clear who's paying for that expense. If the government creates a 1% tax on wealthy people to build a new bridge, we know who's paying for that bridge. It's the wealthy people who paid this tax to build the bridge. If the government creates a new FICA tax, we know who's paying this FICA tax because we can see a direct line between where this money is coming from and what this money did. Now, I'm not saying it's the most efficient use of money, but we can see where the money came from because we can see who paid these taxes. So we understand how the tax system works. The government can raise taxes on some people or all people, and they can use this money to pay for whatever they want, including paying back this debt plus interest. The other thing that the government can do, and I kind of alluded to this in the beginning of the video, is not approve a new tax bill, but still spend the money anyway. And this then has a very unique consequence, because if the government now wants to spend $1 trillion that they don't have, how do they get that money? Because the government still has to pay the bill. The government does not have the ability to just print money out of thin air. And so what the government does is they borrow this money. You have the ability to lend money to the United States government. It is called buying a treasury. Now, the problem with that is the government has spent a lot of money that they don't have, $35 trillion, which can't be funded by private citizens and private businesses alone. And this is where now the government turns to their favorite entity called the Federal Reserve Bank. Now, the interesting thing about the Federal Reserve Bank is although they're called the Federal Reserve Bank, they're not federal. It says so on their website. They're not a reserve because they're not sitting on any cash reserves, and they're not a bank. You and I can't go there to deposit money. However, the Federal Reserve Bank is the central bank in the United States, and they have this unique ability to create money. Notice, the government can't create the money. The Federal Reserve Bank can create this money. So now, when the government wants to spend more money that they don't have, they can call up the Federal Reserve Bank to print this money. And then the Federal Reserve Bank can create this money out of thin air and lend it to the United States government. And then the government can spend this money on infrastructure, on paying back debt, or doing whatever they want to do. But there's a consequence to this. We know who pays for the tax bill, because if you pay the tax bill, you know you're the one that's paying for it. But if the Federal Reserve Bank is the one that's printing the money, who's paying the cost for that? And this is what I like to call the hidden tax, is because it's hidden. If you don't know who's paying the bill, then I hate to be the bearer of bad news, but it's probably you. Because what ends up happening is the government creates this money through the Federal Reserve Bank, and now when you create this new money, the value of each individual dollar goes down because our paper dollars are not backed by physical gold. It's not backed by any precious metal. It's just pieces of paper. And so now when you inflate how many dollars are out there, the value of each individual dollar goes down. The reason why we saw all this inflation in 2020, 2021, 2022, 2023, and even now into 2024 is because the government worked with the Federal Reserve Bank to print trillions of dollars out of thin air. We injected this money into the economy, and the value of each individual dollar went down. The word inflation comes from the word inflate. What are we inflating when we have inflation? We're inflating the monetary supply. We're inflating how many dollars are out there, which causes the value of each individual dollar to go down. So now when the value of the dollar goes down, the prices of things go up. And who does that hurt? That hurts consumers. Now, everybody's a consumer. I mean, everybody's got to eat. Everybody has to buy groceries. Everybody buys things. So when you go out and you buy things, you have to pay more money, which means everybody has to pay more money. But the financially educated, the investors, also benefit from this inflation. Why? Because that's the same inflation that increases the value of your investments, your stock market portfolio, your rental prices on your rental properties, the value of your rental properties. And so now everybody's a consumer, everybody gets hurt, but some people, the financially educated and the investors, actually benefit from this inflation. Now, the interesting thing about inflation is that inflation didn't start in 2020. Inflation has been happening for decades and decades and decades. The Federal Reserve Bank says that they want a 2% inflation target, but have you ever stopped to ask, why do they want 2% inflation? I mean, why doesn't the Federal Reserve Bank want 3% inflation? Why not 1% inflation? Actually, why doesn't the Federal Reserve Bank want 0% inflation? Because 0% inflation would mean that I, as a consumer, don't have to worry about things getting more and more expensive. Actually, how come the Federal Reserve Bank doesn't want negative 2% inflation to make up for all the high inflation that we saw over the last few years? This is a nightmare for the Federal Reserve Bank and for the United States government. Why? Because we have $35 trillion of national debt. What does that mean? If we have negative inflation, this is called deflation. If we have deflation, this becomes more expensive. Inflation makes the value of the dollar go down. Deflation makes the value of the dollar go up. So when you have inflation, money becomes less and less valuable. Your $100 has less buying power when you have inflation. But when you have deflation, your $100 becomes more valuable. It's good to have deflation when you have cash in your pocket. But when you owe money, this debt becomes a whole lot more expensive. And that would mean that the government would have to pay this money back with more expensive dollars, which would make this debt that's already expensive even more expensive. This is why deflation is bad news for the government, is bad news for the Federal Reserve Bank, although it would be good news for the average person. 0% inflation, well, that doesn't really benefit the government because inflation makes this debt cheaper. It allows the government to pay back this debt with cheaper dollars. This is why it is so important for you to understand this, because our economic system is designed to benefit investors. It's not designed to benefit employees. It's not designed to benefit consumers. Now, hear what I'm saying very carefully. I'm not saying that it's bad to be a consumer. I'm not saying it's bad to be an employee. In fact, everybody is a consumer. In fact, most people should be employees. But what that means is you have to get financially educated and you have to learn how to also be an investor. That way you can win in this economic system, because the reality is this system is designed to create debt. Now, going back to the original question, is this a problem? Well, remember, it's only a problem if the government cannot keep making their payments. Right now, the government is making their payments, but the question is, how long will it last? We've heard people talk about, well, if the government's interest expenses keep rising the way that they're doing right now, maybe the government can borrow money to pay back these interest payments. That's when it will become a problem. When the government starts borrowing money or printing money to pay back previous debts, that's when it really becomes a problem, because that means you're using your Amex to pay off your Visa. And that's when you really want to get worried. We're not there yet, but we're at a situation where the United States government is underwater on their collateral. What's going to happen next? Is the collateral value going to rise faster than the debt? Meaning your home value rises faster and now you're no longer underwater? In which case, hey, that's great. The asset has risen faster and we're to pay down the debt. Or are we going to continue seeing our debt levels rise, and we're going to have interest payments and interest expenses rise to an unreasonable and unpayable level, in which case now the government has to borrow money to pay back their interest expenses. Only time will tell, but this is why, again, it is so important for you to be a financially savvy investor and understand what's happening. Now, of course, you can join Market Briefs. It's my free financial newsletter, which keeps you up to date on what's happening in the markets. And if you want a little bit more, you can also check out Market Briefs Pro, which is a newsletter that breaks down a specific financial trend to help give you investment ideas. We're not giving stock tips. We're giving you research on what's happening and where money is moving in our economy. If you want to give it a try, there's a free trial to Market Briefs Pro down in the description as well, if you want to check that out. If you don't have any money to go out and invest, it doesn't matter what's going on in the markets. It doesn't matter if you found an amazing investment opportunity tomorrow. If the stock market glitched tomorrow and you could buy any stock you wanted for 90% off, but you have no money to invest because all of your money is going to pay off your credit card bills, well, that doesn't do you any good, because now you don't have the money to actually take advantage of that opportunity.